I've followed RCP from the second week forward, and I can hardly think of many things which have influenced my thinking and beliefs as much. Chris always mentions to pull up a long-dated chart and put things into perspective, which is super helpful for me as long-term investment with no leverage. Do you still see commodities as the best opportunity in the current moment for after a significant rise? Secondly, most people are mostly focused on the dollar losing the reserve currency status as it is being devalued. Living in the EU and euro being my currency, do you see any different future for the euro or also inflationary outlook for 2020s? I guess we start there, Chris, and then we get into a 30-year fixed rate mortgage question.
Yeah, I mean, there's a lot of focus on dollar is losing its reserve status and things of that nature, because I guess certainly in the publishing financial world, many people are Americans. And so that's a sort of a valid concern, and certainly it's the main currency around the world. Look, we are in a currency crisis. And I say that because if you look at the bond market, it's not representative of any real free market. The rates that are being determined that we see on a quote screen are bullshit. And I say that bullshit because we know that the central banks now own the vast majority of those bond markets. They wouldn't need to if the participants came out, if you and I came out and were happy to place our capital into those markets, but we're not. And so the central banks are owning increasingly those entire markets, and that sets the price for all these other asset classes, and it massively distorts them. That's the situation that we find ourselves in today, which brings me to answering the first part of your question, which is, do we see an inflationary outlook, and do we think commodities are the place to be? To answer that, I'd suggest looking at a typical commodity cycle. Commodity cycles roughly go from 7 to 15 years. Okay.
Right.
The last commodity bull ended in 2012, and you can debate about when that bear market ended, but it doesn't really matter, and it's not going to matter over the course of the next 5-10 years. The point is this: we're in the first inning of it, and many clients and people are looking at this going, "Wow, I just made 3 times my money on a copper stock or on a whatever." Firstly, expect pullbacks. It's going to happen. But again, that's why I say go and look at the long-term charts. Look at the broad picture of this. We haven't even entered this thing really. We haven't even got going. Like, we're just moving out of the gates. We just climbed out of bed, rubbing our eyes, getting that coffee, wandering down the passage, kicking the cat. No, we haven't put our pants on yet. That's my gut instinct on this thing, and just from looking at long-term status. And then with respect to the inflationary side of things, the governments are up against a wall. They have run out of rope on the whole debt side of things. They can either monetize and debase currencies, which is what we had anticipated they might do. And if you look at some of the work I put out more recently, I actually think that's not necessarily what they're going to do. I think they're going to repudiate debt and try and shove everybody into some sort of restructuring, which will be a Nixon-like environment. Oh, you own this? Well, we're reimagining capitalism, George. This is what it looks like, basically, and everybody gets hosed in some. Yeah. So that then brings you very rapidly, like in a heartbeat, into an environment where you say, do we trust this new thing that's been thrust upon us? I'm prepared to say with close to 100% conviction that the answer is going to be no. We're very concerned with this. No, we don't like what you're suggesting. And capital is going to look to flee as far. Capital is already fleeing. The smart money is already moving ahead of that. One of the reasons that I look at Dubai is for that reason. Europeans are flooding into Dubai because they can see that their capital and their wealth is going to get stolen by the governments in Europe and the United Kingdom. And they're looking at this going, it's a wealth tax, it's a whatever, it doesn't matter what the hell they call it, it's coming. And the smart money, the multi-millionaires and the billionaires are all going, holy shit, we're getting out now. And so they're re-domiciling and they're getting themselves into a position where they hopefully won't get rooted in the same fashion. So if what I've suggested does transpire, then it's a sudden knee-jerk, oh shit, what do? We just got hosed. It's like a Nixon event. What do I do? Well, in that environment, you can't trust bonds. You can't trust currency. I wouldn't want to be short the equity market. But within that equity market, you want to own stuff. You want to own something that people will automatically go, wow, we just need to know. Like, you've just had a bunch. If I walked into your home and I just stole a bunch of your money, and you came home and you're like, shit, it just got lost. Your first thing that you think about after being a bit annoyed, or more than a bit annoyed, is to go, wow, I got to protect what I got left because they might come back tonight. So people immediately go into protection mode, and you want to own something that you like tangibly can have some real belief that it's going to hold its value. You want to own commodities. So anyway, that's the first part of that question.
Yeah, and then you just have a really cool comment here. It says, George, in his 30-year fixed rate mortgage argument, I live in ex-Yugoslavia state, and my parents lived in a hyperinflation period. I was not born yet. My father paid off 3/4 of the house mortgage with 4 6-packs of beer. In the end, not even the banks would accept anything but stuff or German marks, equivalent of gold at the time. It went slowly for years, and in the end, it accelerated in a few weeks till the final crack. Positioning ahead changed many lives in both sides. My father-in-law kept his savings in the bank and saved for a house. In the end, he lost everything, and it took him more than 5 years to save it up again. Yeah, it's the Hemingway quote. It just happens very slowly, then all at once. And I've just, if you guys, just quickly here, we'll get to the next question. If you want a great book to read, I've been reading the one that Michael Burry has been referring to in his tweets about hyperinflation, and it's called Dying of Money. And if you Google it, you can just get a PDF and download it. It's absolutely amazing, and I'd suggest everyone read it. But their hyperinflation, most people just think it happened in 1923 as an example. But it really started in 1914. It was a 9-year process, 8 years of kind of a gestation, and then 1 year of boom, just kick you in the back of the head.